SGH Macro CEO Sassan Ghahramani. Sass, it's great to have you on the show. I'm going to start right there because we talk so much about how tight monetary policy has become here in these last 2 years. We don't talk as much about fiscal policy, where we do have these record deficits and where we do see some of these, for example, broad-based industrial policies actually starting to have money sent out and push out into the economy. It's been a very big part of what's keeping this economy resilient, no?
Yeah, hi, Morgan. Thank you very much for having me on again, first of all. Yeah, I think this is, as you mentioned, the fiscal impetus and the economy is something that has been underestimated year after year, and I think will continue to be underestimated going forward. We started off this segment with a discussion of some proposals that President Biden is going to roll out in the State of the Union speech. The problem with these kinds of things is that, it's much easier to lower taxes than to hike taxes. And, we saw that even in the current term of President Biden, where, they had some proposals to raise, broader proposals than these really kind of very micro ones with millionaires and, planes and so on, to raise the tax on, higher earners. And the minute that, Kirsten Sinema sort of put a kibosh on raising corporate tax hikes and tax hikes in general, everybody kind of conveniently folded. So to your point, monetary policy has to offset what is, this fiscal spending that's not going down either under a Biden administration or under a Trump administration. And frankly, I think the odds of having tax cuts are significantly higher, even if you put 50% odds on, either candidate, than actually getting tax hikes in the near future that impact the economy of any size.
So then what's the read-through not only to inflation, but also to Fed policy at a time where we just had Powell testify on the Hill for 2 days and continue to signal that he doesn't know when they're coming, but they are coming, rate cuts?
Yeah. Yeah. And here I'm going to distinguish between, my views on what they should do and, what they're probably going to do. I think from the Fed's perspective, one of the things that we saw in real time was around the turn of the year when they talked about normalizing rates, and we looked at sort of the distance that they could really drop rates between 5 and 3, 3.75 all the way down to 2.5%. In theory, that it rallied bonds to trading well below 4%, and it was off to the races for the economy. And Powell is making that same mistake now. Six months later, they kind of reverted a little bit. They toughened up their message. They sort of changed the normalization story to say that that these are kind of like adjustments that we're going to make, referring to the 1995 Greenspan and all of that. Markets push out, rate cuts to June, and, they don't give a date on it. But then Powell apparently gets nervous today and says, well, we don't know when, but it's going to be pretty soon, and we still have a lot of room. And, it's making the same mistakes. And I think the message is that the economy is wound tighter than what people and economists have been thinking. And the reason is fiscal spending.